Yesterday, CPI came in below expectations, raising new questions on whether we've seen the final rate hike from the Fed. Joining us now, former Federal Reserve Bank of Boston President and CEO, Eric Rosengren. Eric, great to have you with us. The way the markets reacted, they're assuming that we've got a soft landing. Are you ready to make that proclamation?
Yeah, I think more than likely we are going to have a soft landing. So the markets are responding to a good inflation report. I would say that it may be a little ebullient. The core CPI was 4%. The target is 2%, so there's still a way to go. And before the December FOMC meeting, there's still an employment report. There's still the PCE inflation. But overall, I think this is about a good outcome as the Federal Reserve could be expecting, which is a falling inflation rate and unemployment rate that's a little bit below 4%. And an economy that looks like it's growing, but not growing too fast.
Do you think that we've seen the full effects of all the rate hikes?
I don't think we've seen the full effects. Obviously, high interest rates are still affecting housing. High interest rates are going to affect people that want to borrow money for a car. And those effects are probably continuing. But I do think that we're probably going to be seeing a slower growth, certainly than we saw in the third quarter and the fourth quarter, and possibly in the first quarter as well. That's quite consistent with what I think the Fed would like to see. So if you want to get a soft landing, you can't be growing too fast. And so I think it's quite positive that we're going to get moderate growth. It looks like we're seeing inflation going down. Unemployment rate is stabilized at a relatively low level.
Market skeptics, market bears out there, Eric, will say we haven't felt the full effects of the rate hikes yet. So, when those actually kick in to an already slowing economy, that's what could tip us over into, something worse than what we're seeing right now. Can you talk to us about why you think that that will not lead to a recession, even a small recession?
Yeah, I think a slower economy rather than a recession is the most likely outcome. But I would say there's certainly downside risks. So interest rates went up quite rapidly, and we saw last March that a number of banks had difficulties. The long-term rates are still quite high, which means a lot of banks still have significant losses on their government and MBS holdings. So there's still risks in the banking sector that haven't flowed through completely. Clearly, the international sector is still relatively weak. China's not growing very rapidly. Europe is also relatively weak. And we've benefited from relatively lower oil prices in the last quarter. That may not continue going forward. So I think there's still a chance that we'll see some negative surprises, but I don't think that's the base case.
Do you think the Fed goes a little bit more dovish in its language and perhaps its next statement? And how do you think the Fed chair thinks about what that might yield in terms of a further loosening of financial conditions? I mean, certainly what we saw in yesterday's rally was that we saw the 10-year yield go below 4.5, and that was sort of off to the races for stocks. And so you're in this sort of cycle here where, the CPI report comes in and then financial conditions actually get looser, and that could be a concern for the Fed.
Yeah, I think it's probably tricky that they're pretty happy with the direction the economy is going, but don't want to cause the economy to get too ebullient. I would say the statement from the last meeting was quite hawkish. It said extent of additional firming. That is implying potentially even more than one increase. I think they'll probably moderate that language, but still highlight that additional tightening hasn't been taken off the table, something like whether additional firming is necessary. So I do think they'll make a mild change, but for the reasons that you just highlighted, I think they're not going to want to signal that now is the time to start talking about decreases in interest rates, even though the Fed funds futures already has that incorporated. I would also highlight that the December meeting is a summary of economic projections meeting, and it'll be interesting to see how many governors and Federal Reserve presidents have unchanged interest rates for through this year and part of next year. It is quite possible that we're going to see the 7 people that had no change in interest rates continuing to have moderate declines in interest rates through next year. So I think the summary of economic projections from the December meeting will give us a pretty good idea of when easing is likely to occur and how much easing the committee is thinking about at this time.